In this video, we aim to conduct straightforward mathematical comparisons between Roth and traditional IRAs. You've likely heard the common advice that Roth is preferable if you anticipate a higher tax rate in retirement, whereas the traditional IRA is suggested for those expecting a decrease in tax rate at retirement. Assuming you already grasp the fundamental disparities between the two, it's worth reiterating that Roth IRA involves post-tax contributions, meaning you've already paid taxes on the contributed income. In contrast, traditional IRA entails pre-tax contributions, with the taxed portion deferred until withdrawal in the future. Now, let's delve into the illustration. Imagine you're examining a 25-year time frame. Assume a consistent 10% annual return on your investment in both scenarios, with a maximum annual contribution limit of $6,500 in each case. To simplify, we'll overlook other possibilities, such as the option to contribute $7,500 annually after turning 50. Starting with Roth IRA, if your annual earned income is $60,000 and you want to contribute $6,500 to your Roth account, you would pay taxes on the $6,500 allocated to Roth during the tax year, but upon retirement, you can withdraw from your Roth without incurring any additional taxes. The amount of tax you pay depends on your marginal tax bracket. Say you are single and your marginal tax bracket is 22%. Then, you would pay $1,430 for the Roth IRA contribution. In contrast, for a traditional IRA, you can deduct the $6,500 from your earned income, which will save you $1,430 in taxes. However, it's crucial to note that taxes will be due upon retirement withdrawal. To analyze concrete numbers, let's consider three scenarios for Leo. In Scenario 1, we assume Leo maintains a consistent 22% tax bracket throughout the entire 25-year period. While this may be improbable in reality, it serves as a calculation baseline, demonstrating that Roth and traditional IRAs would translate to the same value for Leo. In Scenario 2, Leo's tax bracket is 32% for the first 15 years, then decreases to 22% in the last 10 years. In Scenario 3, we reverse this, with Leo in the 22% tax bracket for the initial 15 years and then at 32% for the final 10 years. For Scenario 1, with a 22% tax bracket throughout, the Roth IRA account compounds to approximately $639,256 after 25 years, with an average 10% annual return. At retirement, Leo can withdraw the full $639,256 without any tax implications. With the traditional IRA, the account similarly grows to $639,256, but Leo has to pay taxes at the end, resulting in a take-home amount of $498,620 after a 22% tax deduction. However, Leo has also saved a compounded $140,636 in deducted tax savings by not paying taxes on the contributions up front, assuming a 10% return applies to the savings. A simple calculation shows that the total value of his portfolio plus the savings equals precisely $639,256. In Scenario 2, Leo starts with high income tax bracket of 32% for the first 15 years and drops down to 22% tax bracket the last 10 years. In this scenario, traditional IRA beats the Roth IRA because Leo saved significantly on tax deductions the first 15 years, which the value of the savings compounded to $194,203. Total value of the traditional IRA in this case is $692,822 versus Roth amount of $639,256. Lastly, Scenario 3 presents the opposite case to Scenario 2. The tax bracket begins at 22% for the initial 15 years and then rises to 32% for the last 10 years. Notably, in this case, the value of the traditional IRA decreases to $585,690 due to the substantial uptick in the tax bracket during retirement. This calculated example serves to illustrate why you often hear that Roth IRA is preferable to traditional IRA if you anticipate a future increase in the tax bracket. While life circumstances are subject to change for anyone, having a benchmark like this can provide valuable insights to enhance your future planning. Additionally, it's worth noting that a strategic approach could involve rolling over a traditional IRA into a Roth IRA during years with lower income in your life. I trust that this video can assist you in planning more effectively. Thank you for tuning in.